Guys, the big headline out of OPEC is that Saudi Arabia is going to cut their production by 1 million barrels a day, as well as extending these cuts into 2024. So, why does OPEC need to cut production when everybody was projecting that oil prices are going a lot higher, especially since the Russian invasion of Ukraine? Well, it could be a number of things. It could be a decrease in demand because of weakening economies or China's reopening is not going as planned, as well as possibly Russia might be actually producing and selling more oil than they agreed to in the OPEC talks. So let's go take a look at some details of this news and take a look at the price of crude oil right now, which is up like 3% because a lot of hedge funds have been shorting the oil market just for these reasons that they think that there is overproduction. And now they're kind of caught flat-footed, it seems. So here's the headline: oil surges after Saudis make additional 1 million barrel per day voluntary production cut, and WTI is up around 3%, just over $74. And so here's a look at the chart right now. It's gapping up. And so they say that Saudi Arabia has made it very clear that mid 70s is a red line, and the price of oil will not be allowed to drop, even if it means temporarily conceding Saudi market share to other OPEC members. So the OPEC Plus members have agreed to extend crude production cuts into 2024, and they're acting to achieve and sustain a stable oil market. And to do that, Saudi Arabia committed to a voluntary cut of 1 million barrels per day, adding that they will do whatever is necessary to stabilize the oil market. And Russia will extend its voluntary oil production cut of 500,000 barrels per day until the end of December 2024. Now, whether Russia is really sticking to this 500,000 barrel a day cut can be debated. And also, they say that the winner from this weekend's talks is the UAE, which gets a boost in its quota for the next year. So this is because some African members were asked to give up part of their unused quota, meaning they had quota, but they couldn't produce enough to fill it. So they said, okay, let's give their unused portion of the quota to the UAE. And curiously, Bloomberg, Reuters, and the Wall Street Journal have been barred from attending the headquarters for the meeting. Now, oil prices were trading pretty low, around $68 just a few days ago, but by Friday, they started to get bid up because of rumors circulating about another million barrel per day cut for the OPEC meeting on the weekend. And I guess they were right. And so the reason some investors might have been covering their shorts is because of Saudi Arabia's energy minister, who made some threats against oil speculators in the run-up to the meeting, saying that the shorts will be ouching. And so Reuters suggested that the OPEC Plus meeting was discussing a million barrel cut among possible options and that everything is on the table. Now, looking at this chart, you see the non-commercial net longs in major oil contracts at their lowest in over a decade. So this is about 100,000 contracts versus about 700,000 contracts long at the beginning of 2022. And this is because hedge funds were betting that OPEC is quietly overproducing and exporting much more than their recent quota permits. But Goldman Sachs is saying bears may be in for a very rude awakening as seaborne net exports by OPEC countries, which announced a cut in April, have finally tumbled by over 1 million barrels per day over the last 2 weeks. So liquids seaborne net exports of Saudi Arabia, UAE, Kuwait, Iraq, Algeria, and Gabon dropped from about over 18 million in the middle of May down to close to 17 million now. So that is a pretty big drop. So OPEC Plus is suggesting that they want to keep the price around $80 to $90 per barrel. Now, obviously, they're doing these production cuts because they can't maintain the price at the level they want because either there is not enough demand or there is too much supply or a combination of both. Now, one of the things that has been increasing supply is obviously the releases from the strategic petroleum reserves. But another thing that is a lot harder to measure is possibly the Russian price cap on oil, where if they sell their oil above the price cap that the EU and the US decides, they're not allowed to use EU member shipping and insurance. So, what that caused is a whole fleet of Russian ghost ships that are moving around this oil and doing ship to ship transfers in the middle of the ocean. So Russia may actually be selling a lot more oil than what they agreed to in the OPEC agreement. So let's take a look at that. So you have India's imports of Russian oil at a record high. So India imported more oil from Russia than it did from Iraq, Saudi Arabia, the UAE, and the US combined. And their import of Russian crude may have undermined OPEC, with OPEC's share of imports in India hitting the lowest in at least 22 years. So before the war, India was a marginal buyer of Russian crude, and now it's the most important market for Moscow's oil alongside with China. And so Indian refiners are not complying with the G7 price cap, and so they buy the cheap oil from Russia and refine it, and some of it is making its way right into Europe. And so they say Russia and Saudi Arabia are at odds after a flood of Russian oil supply pushed the commodities price below a key break-even level needed to fund Saudi projects. So the Saudis are not stupid. They know Russia is pumping more than they agreed to. And Russia knows they know, but Russia probably doesn't care because they need to fund their war. So they're going to sell what they can sell to whoever will buy it. So the increased supply of oil from Russia is hurting Saudi Arabia's needs to fund its mega projects. And so they say the price of oil needs to be above $81 per barrel for Saudi Arabia to be able to fund their budget needs. And there's even a quote saying Saudi officials have complained to senior Russian officials and asked them to respect the agreed cuts. But they say recent data suggests Russia isn't following through on its side of the deal. So Russia may be cheating on its own pledge to slash oil production. So they say Russia continues to export huge volumes of crude oil despite previously saying it would slash production, and global energy demand is slowing as recession concerns mount, and the additional oil supply is weighing on prices. This is why OPEC needs to cut their production to get the price up. So the Wall Street Journal is saying traders are thinking Moscow could be cheating on its own pledge to slash production. And so the additional supply is weighing on oil prices, which are also under pressure from fears about a recession and doubts about a rebound in Chinese demand. Now, in February, Russia said it would cut production by 500,000 barrels a day, but they say exporting more oil isn't the same as pumping more oil out of the ground. And so it's possible Russia could be cutting production while boosting exports in the short term, the drop off coming later. And they say Russian data show more oil wells were idled in March, suggesting less production activity, according to Bloomberg. And so Saudi Arabia needs oil to be above $81 a barrel to help fund its massive giga projects, which include a 110-mile long city in the desert called The Line and a resort in the Red Sea that's the size of Belgium. And so economic advisors say the kingdom needs higher oil prices for the next 5 years to fund these projects. And that's also in part because the projects have failed to attract a lot of investment from abroad. So while Saudi Arabia needs this $81 a barrel oil to fund their projects and these resorts in the sea and all of this stuff, Russia needs the money to fund their war. So when push comes to shove, if it's a decision between funding your war or abiding by the OPEC plus decisions, I'm sure Russia is going to choose what's in their best interest for the time being. Who knows? This could all be theater. Russia may have an agreement with Saudi Arabia to have their blessing to do this extra production and selling their oil to fund their war. And then maybe they give them some kind of concession later after the war is over. Either way, although it might be bullish for oil right now, especially with investors and hedge funds being short oil a lot, that may bring the price up a little bit in the time being. But for OPEC to have to do these pretty drastic cuts right now is showing that either the demand is not there or there is still too much supply. And guys, this is a good lesson to look at in the stock market. When you're looking at a stock or a group of stocks and something doesn't make sense, like you see the Russian invasion and we have to refill the SPR, and China is going to be reopening up, and all these things that are supposed to be bullish for the price of oil, and yet the price of oil has done nothing but kind of just trend down since the invasion started. So when things don't make sense, they do make sense. It's just that you don't know what the real reason is. And so usually that reason comes out later. Either there's a whole bunch of OPEC countries that are cheating and producing more oil than they agreed to, or the demand is just not there because the economies are weakening a lot more than what they are telling us in the news. So will there be a pop in the price of oil and oil stocks? Yes, probably, but it seems like they are fighting to prop up the price of oil. So these headlines and predictions that oil is going to $120 or $140 a barrel may be really overly optimistic. And so that may be reflected in the price of oil company stocks very soon. Invest accordingly. Thanks for watching, guys.